Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so we have accounting change number 2. We have a change in accounting principle. And this is talking about a change from one US GAAP reporting methodology to another US GAAP reporting methodology. All right, so this will never be a change from one US GAAP method to a non-US GAAP method. Great examples always going to be changing from accrual accounting to cash accounting, right? Because the cash basis of accounting isn't US GAAP. So therefore, this would not be considered a change in accounting principle. This would be considered an error. All right, so we'll talk more about this when we get into our error corrections. But for now, we're talking about changes in accounting principle. So you're thinking GAAP to GAAP, all right? So very common scenario that you could see on the exam is changing from one inventory method to another inventory method. All right, but what did we talk about when we discussed changes in accounting estimates? We said this will not include any changes from one inventory method to LIFO specifically, okay? Because that would be considered a change that is inseparable from a change in accounting estimate. All right, but if, on the other hand, this was a change from LIFO to FIFO, for example, then this would be considered a change in accounting principle. It's only any change from one inventory method to LIFO that would be inseparable. Another change that we need to reiterate that is inseparable is a change in depreciation methodology. Right? Technically, that is a change that is one US GAAP reporting method to another, but it is considered what is inseparable from a change in accounting estimate, right? It's essentially indistinguishable. Okay, so therefore both of those situations would be treated prospectively. So again, we need to ask ourselves the two questions, the how and the when. So the how is discussing how we are making this change, right? What is the value that is going to be recorded? And what you always need to remember is when it comes to changes in accounting principle, the impact is always going to be calculated net of tax. All right, so if you see something that is considered a change in accounting principle and they give you a tax rate, the impact is always going to be calculated as that amount multiplied by 1 less the tax rate. Okay, conceptually, that's how it works. We'll make more sense of this when we go through an example. All right, but at the end of the day, that was question number 1. What was question number 2? So we mentioned this is the more important question, and that is the when. In other words, what period will this adjustment be recorded in? So changes in accounting principle are going to be different from changes in accounting estimates. And they're going to be different because we never are going to record these prospectively. They will be recorded retrospectively, meaning we're going to be recording them backwards. Okay, so we defined prospective. Let's define retrospective. This is an adjective, and it means looking back on or dealing with past events or situations. All right, so to solidify this in our brains, let's think about our friends over at Retro Music Company. All right, and Retro Music Company sells products to their customers that are considered to be a blast from the past. Right, whoa, that's very retro. Okay, so when this company presents its financial statements with adjustments from changes in accounting principle, we already said that the cumulative effect will be an adjustment that is made net of tax, but now we must ask ourselves, what period is this adjustment going to be made in? And we need to ask ourselves, are the financial statements being presented as comparative financial statements or not? Are we showing the financial statement readers the financial statements for just this year, or are we showing them previous years that might be impacted from this change as well? So very simply put, if we are not showing comparative financial statements, right, we're only showing the financial statements for this period, then the cumulative change will be made as an adjustment to the beginning retained earnings amount for the current period only. All right, so that's going to be for this period only, right? So when in doubt, the adjustment will be made to beginning retained earnings at the earliest period presented. But again, That's talking about a situation where we are not showing comparative financial statements. But what if we are showing comparative financial statements, right? Maybe we're showing financial statements for years 1, 2, and 3, and the adjustment from the change in accounting principle occurred in year 3. Now what we need to do is show an adjustment to beginning retained earnings as of the earliest period presented, which in this case would be year 1. All right, but something else that is super sneaky to note in this situation is that we also need to show how the change would have impacted the financial statements for every single year presented. All right, so in other words, let's say we're changing our method of inventory from the weighted average method to FIFO. So now we're telling financial statement readers, look, had we used FIFO this entire time, this is what the cumulative impact would have been to income in year 1, year 2, and year 3. And now we are showing them what the adjustment would have looked like to each respective year had we used FIFO the entire time. Alrighty, so let's bring back Retro Music Company. Whoa, blast from the past, right? So we're going backwards in time. So in our first scenario, we're saying that we have no comparative financial statements, all right? So on January 1st, year 3, Retro Music Company changed its method of recording inventory from LIFO to FIFO. Okay, LIFO to FIFO is in the clear. If it was FIFO to LIFO, then it would be indistinguishable, right? It would be inseparable from a change in accounting estimate. But because we're going LIFO to FIFO, this is going to be a change in accounting principle. All right, so before year 3, the company's pre-tax income under LIFO amounted to $400,000, while after the change was made, its pre-tax income under FIFO amounted to $500,000. So we're going to assume that the company had a 35% tax rate, and we're only showing the financial statements for year 3. So we want to determine the cumulative effect to net income. All right, so the adjustment is $100,000. Okay, so in the event that we used LIFO, it was $400,000, but after we switched to FIFO, the amount was $500,000. Okay, so the net impact was $100,000. All right, but what we remember is always when it comes to changes in accounting principle, this will be presented net of tax, right? That's the how. All right, so 100,000 is going to be multiplied by 1 minus the tax rate. Okay, so 1 minus 0.35 is going to be 0.65. 0.65 times 100,000 gives us a net $65,000 adjustment, right? This is the amount that we're adjusting it by net of tax. Okay, so question number 1, the how. We already did that. Now we need to address question number 2, the when. What period is this adjustment going to be made? And we're going to make the adjustment as of the current year, right? Beginning retained earnings as of the earliest period presented. So we're going to be making this as of January 1st, year 3, right? We're not showing the financial statements for years 1 or 2, but let's say that we are. Okay, so same facts here, only now we're saying that the company is presenting all 3 years of its financial statements. Okay, so the how, we already addressed this. This is going to be the $100,000 adjustment net of tax. So we have a $65,000 adjustment. More importantly, let's address the when. In what period is this adjustment going to be made? Okay, so again, because this is a comparative financial statement that is getting presented, we need to make the adjustment to the earliest period presented. So we're showing the financial statements for years 1, 2, and 3. So we need to make the adjustment to beginning retained earnings as of year 1. Okay, so the adjustment would be made to beginning retained earnings on January 1st of year 1. All right, but something else that we mentioned that is sneaky important to note when it comes to changes in accounting principle with comparative financial statements is that we need to show the impact to every single financial statement presented. Okay, so the company would also display the adjustment with the new inventory method of FIFO for all of the years presented. So that would be the impacts to year 1, the impacts to year 2, and the impact to year 3. All right, but most importantly, the adjustment would be made as of January 1st, year 1, beginning retained earnings of the earliest period presented.